Good morning, everyone. I should say good afternoon. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with Claudia Sahm. She's chief economist at New Century Advisors and a former Federal Reserve economist. Also, Connor Sen, my colleague at Bloomberg Opinion. We're here to talk about the Fed. The expectation is that we will have no change, of course. The range will stay at 4.25 to 4.5%. But all eyes will sort of be on expectations. The consensus view among economists surveyed by Bloomberg is that the Fed will still, that median dot will still imply 2 cuts this year, but there's plenty of room for little wiggles here with all the uncertainty that's introduced by tariffs, new questions about supply shock from oil, and so on and so forth. So, Claudia, to you first. What's your expectation for today, and where will the real news come?
So I expect the Fed is firmly in risk management mode, right? And they're facing a lot of uncertainty, a lot of risk. Tariffs will come up today. This is a big focus. It's a key inflation risk, but it's really not the only one they have in terms of the outlook. And that's where their wait and see mode is coming from, is trying to not move ahead of what could be inflation that ends up being sticky, or they're not clear yet how much things are weakening in the labor market. So, but I think, the pressure is increasingly on the Fed to justify this. I mean, coming into this meeting, inflation has been slowing down. We've had weaker than expected inflation data. The cooling in the labor market has been very gradual, but, dial back to last year, Powell told us multiple times, we don't need to see 2% before we do the next cut. Like, we just need to see the direction. So now they got to really tell the story. Like, well, why are you on hold? Like, what is it that you're so concerned about? And what are you going to be looking for as you kind of make these decisions as the years go out? I think, we might get some hints of this in the statement. Mainly, I'm looking to the press conference with Powell to get the storytelling. The summary of economic projections might help with telling the story, but unfortunately, they fall really short in terms of tell us about the risks. What are you thinking about there? So I think it could be a little messy today, but I don't really think we're going to, get a lot of change in terms of the Fed's outlook.
Okay, Connor, what about you? What are you thinking going into this? And any response to what Claudia just said?
I think she's right about the risk management. And my concern this year has been really since the election, and then particularly since President Trump took office and started talking about tariffs, putting in tariffs, then the tax bill going on. Part of their way of doing risk management is just not telling us a whole lot. So it'd be one thing if they said, well, we don't think we're going to do anything until September because we're waiting on X, Y, and Z. But it's really just been a lot of, we don't want to say anything because anything we say might be misinterpreted. And as a result, for investors or the general public trying to understand what the Fed's thinking, we don't really know. And so what I'm going to be looking for in the statement is, do they acknowledge any sort of softening in the labor market, housing market, the cooling in inflation over the past few months? Do we get any kind of update on what's changed since certainly the March meeting, but also the May meeting? Or is it going to be more of the same? Let's not say a whole lot, maybe mark the forecast to market, but continue just to wait and see, when I think that risks, and I think Claudia might agree, are building. And there's a chance that we could get to a point later this summer or this fall where they have to pretty rapidly change their outlook.
Yeah. Claudia, we've got about a minute to go here. Is this the right communication strategy from the FOMC, essentially not telling us very much, not locking themselves into a path?
So they shouldn't lock themselves into a path, right? That would be poor policy making. I think everybody can agree we don't know where this economy is headed, and we really have some unusual shocks that are hitting it. So it's not a time for the Fed to say, hey, we're going to cut in October. We're going to take some time off. We'll be back, right? Like, that is absolutely not the message that needs to happen. But they could give us more on, how are you interpreting this? Where do you think the policy is going? Where is the risk going? Like, instead of just, it's uncertain, we don't know, we're not confident, like, try to fill in the thinking, because they're doing this internally, right? So there's just a question about how much they want to share. And it is difficult, but that kind of conversation, I think, will be helpful. And they're going to have to do more and more of it as we get more and more data. Like, they've got to explain what they're seeing.
Yeah. All right. Well, we're expecting the decision in just a moment here. So it does come in no change, of course. Policy remains in that range of 4.25 to 4.5 percent. Let me get you the headlines as they cross. So Fed holds benchmark rate in 4.25 to 4.5% target range. Fed lowers the 2025 GDP estimate to 1.4%. Lifts inflation outlook for 2025 to 3%. Here's your news on the dots. The FOMC medium forecast still shows 50 bips of rate cuts in 2025. And here's some headlines now crossing on the statement. This is Andrew Dunn reporting on our Top Live blog. The Fed, uncertainty about outlook has diminished, still elevated. These are your snap headlines here. We do see the S&P 500 moving up a little bit. That's the knee-jerk reaction off of the back of this. Nothing spectacular. Again, the dot plot for 2025 unchanged. So let me just go right back to you, Claudia. It sounds like this is consistent with the way you set the table for us here. Any immediate surprises jump out to you?
So I'm watching hours of my life be wiped away, looking at these dots, because the news, the interesting story in these is what's the 26 and the 27 dots.
Yeah.
Right.
Okay.
So I think this is where they're saying, oh, yes, just like we told you in March, we think probably we're going to do a couple cuts by the end of this year, which is incredibly good news. That is the Fed telling us that they have their baseline. And it's, the median is not a consensus forecast, but, just kind of looking generally, this is them saying, yes, we do expect inflation to pick up. And, the median is to right around 3% by the end of this year. But we will have enough conviction that that is temporary and that it's not going to require us to be more restrictive or even that we'll be ready to start cutting. That's a huge thing. That is this baseline of these tariff-induced or, temporary. Okay, right. But then the median for the Fed funds path goes up in 2026 by 25 basis points, and is also up. Then it's up, when you get about the same, they carry that into 2027, and so it's anyways. But this is a good example of do not get into false precision on the summary of economic projections. I mean, I am happy that the wrinkle is showing in the out years, and that's not going to be the market reaction. They're looking at that 50 because who knows what's happening in 2027, right? Let's not get worried about that. But it is an example of just there's a lot of precision to this SEP that's basically false precision, because I can't even imagine how you would tell that story that we're convinced we can start cutting this year, and yet we don't think we'll be able to cut as much and fast. I don't know.
Right. But if we did want to get into some wild false precision, we could totally overanalyze what's going on with the long run dot, which stays at 3% and has really sort of been settling in there. It seems to me that there was a period of a year where we saw expectations of what you might call long run neutral steadily drifting higher. That was also true in the private sector. If you look at something like the New York Fed survey of primary dealers, but the great revision of long run neutral really seems to be over here. Is that a fair assumption, Claudia, you think?
Well, for the long run estimates tend to be revised much less frequently, right? Because they shouldn't be moved around by the recent noise. It would have surprised me given the fact that inflation has been coming down. Even we just haven't had a data landscape in recent months that would push them in fact, the neutral rate's higher. It would have been a little strange to see that today. But I mean, that is absolutely an open question. And you can see, and one good feature of these summary of economic projections is you can see there are real differences across committee members in terms of how some see us as being pretty restrictive and others see us really not a lot of restriction at all. So there's variation across the committee. So that debate's ongoing, but I'm not surprised that it didn't move today. So.
All right. Well, checking back in on markets, it seems like we had an initial knee-jerk positive reaction as the risk event sort of passed, and we've now almost completely reversed that, and we are back to where we were shortly before the 2 p.m. Release. Connor, heading over to you, you think about policy a lot in terms of what it's going to mean for the housing market. Uh, Given the assumptions we're seeing today, essentially a Fed that is not necessarily going to be on hold forever, but is going to move fairly slowly in the face of what is also some cracks in the labor market. We've been seeing continuing claims sort of drift higher. If you look at sort of a 4-week moving average, what does this mean as we look 6 months, 12 months ahead for the housing market?
Well, I think, down here in Atlanta, surprisingly, the spring housing market is almost over already because back to school is the first week of August. So you have to be in your house by early mid-July. So we've kind of lost another year of the spring housing season, which is crazy. But I think to your point, even if they were to cut a couple times later this year, that's already priced into the curve. So that wouldn't really move mortgage rates in a meaningful way. So I think the story of the housing market, again, barring some big change in the economy or interest rates over the next 3 to 6 months, is a continued increase in resale inventory, more downward pressure on home builders who are struggling to compete with a softer economy, high interest rates, and more resale inventory. And I think we're getting to a point where, yes, there are still a lot of people with low mortgage rates who don't need to sell, but a lot of people have been on hold for 3 years and they need to sell, or they feel they need to sell to move on with their lives. And now there's a lot more inventory, particularly in the South. And you're going to see a price discovery period as people transact for the first time in years. And I think given how poor affordability is nationwide, that price discovery period could be pretty disruptive. And that's the concern I have as we head into the back half of the year.
Yeah. There's there's this cliche that the housing market is the economy. And maybe it's more than a cliche, right? Uh, is it a problem if we see some year-on-year home price declines in the national indices here? Is it fundamentally a problem given what we've been through over the past 5 years and the affordability problems that are widespread?
So I think that's a real robust debate because it's easy to say home prices are very high. They need to come down for affordability reasons. If you look at any kind of historical chart ratios, affordability ratios, they're all out of whack. So on that level, prices do need to correct. But on the same time, you have home builders who, like Lennar, which is the second largest home builder in the US, reported earnings this week, and their profit margins are at the lowest, or sorry, the price incentives they're using to sell homes are at the highest level since 2009. So it's sort of a mini crisis for them. And if prices were to fall 5-10% from here, you're going to make home building basically uneconomic almost everywhere in the country. And so that's going to make the production story worse. It's going to mean job losses in construction. It certainly isn't going to help with building more homes for Americans. And I think there's a real question about, and then also the household wealth effect. Like, yes, people have a lot of home equity, but if prices start falling, what will that do to psychology? Is also from the Fed standpoint, shelter is a huge piece of CPI and inflation. And if home prices are falling, it's really hard to justify that inflation is a problem nationwide. So there are a lot of layers to this, but I do think that a decline in home prices would be unwelcome, even if you do need sort of better affordability. It's kind of a tough spot we're in right now.
Right. So we're trying to walk this tightrope. We want to make sure that the incentives are still in place so that we can keep addressing that housing deficit, that massive housing deficit in the country, which I've seen estimates anywhere from like 3 million to 7 million homes, right?
I think the way you'd want to get through this is 3 to 4% wage growth, flattish home prices, and gradually falling interest rates to sort of slowly build back affordability. Not have home prices fall 10% overnight and deal with the disruptions that would entail.
Right. So Claudio, back over to you. So we heard you sort of accurately describe what we would see from the FOMC today. But what does Claudia Sam think we should be doing here, given the balance of risks, especially taking on board the recent trends in claims, which seem to be hinting at a further increase in the unemployment rate in the months ahead. how does all this shake out? Of course, there are risks to inflation and inflation expectations going forward, but that's never in question. The question is, what is the greater risk? The risk to the labor market, or the risks that we see in the inflation indices?
Right. And I think the other important piece to think about with the Fed is, for them, there's a real benefit of acting quickly. Right, not too quickly, because they don't make the wrong call. They don't want to be wrong, but it is one where, as we're starting to get the data since major policy changes like the tariffs have come into, you're really trying to sift through and look for subtle signs. And I went through this exercise, particularly after the last CPI that came in soft, and it's like, and apparel prices are falling, and like, what is going on? And I do think, like, when you go in and really poke at the data, there's as much sign of some demand weakness in there. It's modest. It's not like, things aren't falling off a cliff. And there were concerns, given all the uncertainty and kind of the panic in early April, that we might see that. And we didn't have that. This is very good. But in trying to, this isn't the environment of 2021. And the Fed it's very hard for any policy. Like, you kind of think about the last war. I mean, I certainly think about the mistakes I made with inflation in 2021 and 2022. And so you got to kind of discipline yourself and be like, well, but this is different. And the demand situation is really different than before. So I think there is a risk that the Fed kind of overplays the inflation and kind of misses the demand, the weakening that we're seeing. But for right now, because inflation still is elevated, it's been elevated since 2021. Like, I agree with the path they're on. I just want to make sure I keep hearing them go and look at these puzzling things that might suggest more weakness, and be ready to pivot quickly, which again is like, don't commit to something far off in terms of, we're not going to touch rates, because we're starting to learn stuff. But I like where they're at right now, but it's how they handle it going forward.
Yeah. Well, I did want to real quickly go through the Fed in their own words here, and share what's changed in the statement. Maybe that'll shed some light on some of these discussions. So just to run through the key changes in the statement here. So they changed the second sentence in the characterization of the macroeconomic environment a little bit. It used to say the unemployment rate has stabilized at a low level in recent months, but it now says the unemployment rate remains low and labor market conditions remain solid. Okay, so that's a nod to the reality that, yes, unemployment is low, but maybe we need to start thinking about the trajectory a little bit more again here. Now, in the second paragraph, the other key change is it had said uncertainty about the economic outlook has increased further, but it now says uncertainty about the economic outlook has diminished but remains elevated. And I guess there it's a nod to the fact that, nobody knew what tariffs were going to look like. Now we've had tariffs, and there's some vague sense that if we're moving in any direction, that direction is going to be de-escalation. I personally kind of don't know. I think we're getting an awful lot of mixed signals on that front, but that's how the committee is reading it. Connor, did you want to jump in on any of that language?
Something I want to keep in mind, because it's easy for us to look at the statement and see how it changed versus May and how the dots change versus March and say, okay, this is where they are and this is what it means going forward. But I am thinking back to last summer when we saw this kind of sneaky rise in the unemployment rate. And I remember when we got the July employment report in early August, and we saw the unemployment rate rose to 4.3 or whatever it was. And it was like, oh my gosh, like the unemployment rates rose in 5 out of 6 months. And I think in late July last year, you never would have thought the Fed might cut 50 in September. And then I don't know how we got there, but whether it was Powell made a call or whatever, but I remember you heard Fed members in August say, yeah, we're considering a cut in September, we'll see. And then they unanimously, or maybe not unanimously, but they cut 50 in September. And so I think even though this is telling us where they are today, things could change very quickly over the next 2 to 3 months. And we should be prepared for a range of outcomes in September, and that this, as Chair Powell will tell us in 15 minutes, is just a snapshot in time. And ultimately, the data will determine what they end up doing later in the year.
That's right. Well, and in a sense, to be in this business, you have to have a view about where we're going. You can't just be looking in the rearview mirror all of the time. And the key question here is, we have a sense that the trajectory is upward in unemployment, things like claims. And we have a head scratcher in inflation, because on the one hand, the data is telling us, the inflation data is telling us that the trajectory is towards disinflation. On the other hand, there's this sense that we have these sort of supply shocks that are just coming online now, that the impacts from the tariff policy might not be felt until, say July, August, September, or whatever. And we have this new question that has really just developed over the past week or so about potential resurgence in oil prices due to the Israel-Iran conflict. And there's always this question. The sort of orthodox thinking is, you have one short-run supply shock, you kind of look through it. But what do you do when you have two supply shocks happening simultaneously of unknown duration, and they're coming on the tail end of the most disruptive inflation in 40 years? What do we make of that puzzle, Claudia?
Yeah, what you're describing, these are all reasons the bar for action at the Fed right now is higher. Right, there's uncertainty. It's not that they won't act, and I mean, Waller's made this point. Like, the Fed will cut in pricing when things are not like, but the like what they have to see to start moving is just it's more. Right. So I think, I do think that by the end of the year, the Fed probably will start cutting. They'll get more, conviction that the risks of like really big boost to inflation from tariffs is probably not as much. Like, we're going to have something modest. We have other disinflationary forces that have been with us for a while now that are going to keep going, that can offset some of that. And this is very consistent with their forecast too, that we'll see more softening in the labor market. We'll have the unemployment rate drifting up, and it'll be that combination. It'll be like, okay, now it's time to cut, despite the fact that we are above the target. Inflation is still high, and it's going to take a while to probably work out the inflation to get it, to reverse itself. But the Fed, they will get there. It's just the bar is too high right now for them to make an adjustment. They don't have enough conviction in their forecast, I think, for good reasons, and there's not the forcing event to get them to cut. But the fact that they're writing down, hey, we think the next adjustment will be cutting rates despite inflation moving back up, that is telling us something. It's just, we don't know when.
Right. Connor, you're sort of a master of the pointed take on these sort of things, and I saw a great post from you about how, if you want to understand where the cycle is going, look to Florida and Texas. Don't look to the Northeast. Unpack that for us a little bit.
Well, I think to the extent that the housing is the business cycle, and there's probably at least a correlation to that. It's not 100%, but 50, 60%. The Northeast, which is a huge policy failure, by and large doesn't build housing. And so the housing production in this country tends to happen in the South and West. The housing boom bust in this cycle has been in the South and the West. Those boomed really hard in 2021, the first half of 22. That led to inflation that started in the South and spread throughout the country. And what we're seeing now is a pretty rapid cooling in the housing market and a buildup in inventory in these places, even while inflation and shelter inflation in particular in the Northeast and Midwest remains somewhat sticky. But I do think ultimately Florida and Texas could be a leading indicator for broader problems and cooler inflation. And we should pay attention to that even while New York struggles to build housing. Yeah.
Claudia, we talk about the uncertainty that the policymakers are dealing with, and there are so many things we could go deep on here. Obviously, we've talked about tariffs, we've talked about Middle East conflict. We haven't really touched on fiscal and the big beautiful bill, and we also haven't touched on immigration, right? Which is sort of a massive aside from the very important human story there, it's also a massive supply shock of its own, right? I saw estimates from Morgan Stanley that net immigration is dropping from I think it was between 2 and 3 million in 2024 down to something on the order of 0.3, 0.5. That's a big change, right? How does that shake out in your models and your thinking about the future?
Right. The economic effects of immigration. I mean, we had a massive increase in immigration in recent years. That was very crucial in terms of boosting growth, addressing labor shortages. I mean, if you on the economic side of it, there were a lot of benefits from that extra immigration flow. Now we're like very rapidly pushing that in reverse. Is a question as to how, like, if we will actually see net negative migration into the United States this year or not. I mean, it's it's unclear how. I mean, we know it's apparent the immigration into the country has dropped off rapidly, and then there's the big discussion about deportations, which even just how they're done can have huge effects on local economies. And so that's kind of playing out right now as we speak. In terms of from the Fed's perspective, trying to get a sense of where the labor market is, it makes it a lot harder. Because this is, as you said, it's a labor supply. It's like, what's the workforce? It's very difficult to measure this in real time, particularly with immigration and all the different work authorization statuses. But if like job growth is slowing, and we've seen some of that, if it's happening because we just have fewer workers, well, that's actually not something the Fed can do much about, right? That's just like the economy is slowing down. Our potential is less because we have fewer workers. So there's where you look a lot at the unemployment rate. What's the people out there getting jobs? But as last year Connor mentioned the increase in the unemployment rate last year. Part of that kind of the signal was more negative because part of that increase in unemployment rate was like we had more workers coming in and it's taking time for them to have jobs. And so that's like a good reason the unemployment rate goes up. And so because later it's going to end up giving us more growth and all this. We're doing that in the reverse right now. Like there's a potential that we end up with low unemployment in like a bad way. Like we don't have enough workers,
Right.
labor shortage. I don't think we'll see that nationally, but we definitely could see pockets of that. And so it's again, there are so many really big policy changes hitting the economy. We don't even know fully what they are. And then we're trying to trace out the effects of it. And our data, our ability to monitor the U.S. economy in real time, this really puts it to a stress test in terms of discerning like what's really happening here.
Right, exactly. So there's the uncertainty about policy itself, and then there's the added uncertainty of how do you read these conflicting signals in the data? What do you make of a stable or low unemployment rate in an environment of essentially collapsing non-farm payrolls gains? Very, very complicated environment. We have about 7 minutes until the Jerome Powell press conference, so we want to wrap this up before that happens, so everybody can get over there. I have put the yield on the 2-year Treasury note up here just for the sake of conversation and to show that this data dump thus far hasn't really changed the outlook very much. I think heading into this, we were looking at a 3.93% 2-year Treasury note, and we are down maybe 2 bips. So that could easily be erased in the next 7 minutes, or with Jerome Powell's opening statement even. But with the time that we have left here, Connor, I'll go to you first. What would you still like to hear from the chair when he takes to the podium?
I think like Claudia said, I want to hear their thinking more. And I don't want any commitments to policy. I don't think anybody thinks that's appropriate, but just how are they thinking about, I mean, I know they don't want to touch on fiscal policy and White House choices, but what do they truly think about the labor market and the extent that housing weakness is going to play into shelter inflation, which will play into core inflation? Just help us think through what they're thinking about, because like she said, they're talking about it internally. The statement we got and the dots we got was really more of a marking the market rather than new information, I think. So
Yep.
I still don't feel like we have a great idea of what they're thinking. And just the more we can understand the trade-offs and the risks they're weighing, I think the better for everybody.
Yeah. What about you, Claudia? What are you still looking to hear from Chair Powell?
Yeah, I don't know how well this would go. So if it happened, but it is, we're going to hear the word uncertainty and risks a lot. There is really something to be said for him spelling out some of those scenarios with a little more detail. Again, Governor Waller had a good kind of thinking about his tariff scenarios. I don't expect, this is not the time of the press conference to give such a long discursive kind of description, but just something that would put a little bit more meat on the bones in terms of what they think of as these risks. What are they looking for that would take those risks down, right? And so some of that discussion, I think, would be helpful in terms of like kind of thinking about what's coming ahead. But it's not like the Fed doesn't tend to do a lot of that scenario analysis. And frankly, sometimes it's hard enough to just explain the base case. So this might not be the time to roll this out, but I know that's something they've been having a lot of discussion with, with the summary of economic projections and the communication policy. It'd be interesting to see if, make any progress on trying to figure out how to convey those risks with a little more detail.
Sure. And one follow-up for you, Claudia. There has been this tendency in the markets to, believe that what the chair says, that's what really counts. The move that happens during the press conference, that's the one that really defines the market day. But let me ask you this. Does it feel like Chair Powell speaks for the committee right now? There's been some analysis. I think even at our in-house shop, Bloomberg Economics, that maybe Chair Powell is toward the more dovish side of the committee at the moment. Do we think that we can extrapolate his words to this is actually going to be the outcomes in terms of policy?
So, the role of the chair is to speak for the committee. Right. And Powell's not a rock the boat kind of person. So, obviously his views will shape to some extent and clearly shape the committee's discussions. But I do take, and I feel like he can even be pretty clear sometimes. He says, well, this is my opinion, like trying to separate from it. So I think this is telling us something about the committee as a whole, which given some of the political back and forth, right, like Powell's not the one that decides we hold or we cut by 2 percentage points today, right? This is a Fed. He's the figurehead. He's the one. He's the chair. He's out there. He's the leader of it. But it's not. It's an institution that is kind of speaking. So I don't know that for like exactly what comes out of Powell's mouth. That'd be really hard to parse out. But I do think he's the closest we get to the Fed, the committee, kind of telling us their view in kind of this less scripted environment like the press conference.
All right, fair enough. Wise words as we try and process what's going to go on over the next 45, 50 minutes or so. With that, we're going to wind down and let everybody get over to the all-important press conference. Many thanks to Claudia Sahm, Chief Economist at New Century Advisors, Connor Sem, Bloomberg Opinion columnist. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Your Fed is staying on hold at 4.25 to 4.5%. The expectation in the median dot is for 2 cuts here, and the market kind of unimpressed, unmoved at the moment. Thank you very much, and we'll be back for more macro coverage shortly. Take care.
Thank you.